I have 1 o'clock on my my clock here, so we will get started. Thank you for joining us today for our 1031 Exchanges Advanced Topics webinar. I have about 57 slides. It'll go relatively quick, hopefully. At any time, if you have questions, just type them in the chat bar and we will answer them as we go. I'm also going to have a time for questions at the very end of the presentation. So let's get started here. One other thing is we did a kind of a essential concepts webinar, and if you missed that, we can send you the link. I think we can, Lindsay, is that accurate? Give me the thumbs up.
Yeah,
yes.
We still have it.
Okay, great. If you missed that, we can send you the link to watch that recording if you're interested. So with that, let's get started here. A little bit about myself. If my computer's going to work, there we go. My name's Dave Tornell. I'm the commercial sales manager for Chicago Title. I've been with Chicago Title for almost 5 years now. And prior to that, I worked for IPX 1031. Who was a qualified intermediary here locally and nationally. I covered Arizona and New Mexico, did that for 13 years. I'm also a certified 1031 exchange specialist through the Federation of Exchange Accommodators and speak and teach on the topic quite often. But anyway, with that, what are we going to talk about today? A little bit of review. If you didn't catch that first Essentials presentation, we'll kind of go over some of the basics of 1031. We will go back over the statutory requirements, just some of the rules that we have to follow when we're doing 1031 transactions. And then we're going to get into some exchange structures. We will review just the basic timelines and structures as far as 180 days on regular exchanges, but then we'll also talk about reverse exchanges and build-to-suit transactions. And how investors can take advantage of those two different structures. We'll get into related party transactions. There are some no-nos when it comes to that under the IRS regulations. We'll talk about refinancing and 1031 and when's a good time to do that if you are considering doing a 1031 exchange. And then last but not least, we'll get into some of the partnership issues. If you've ever been in a partnership, you always have issues. No, just kidding. If you've ever been in a partnership, when it comes to 1031, sometimes partnerships want to dissolve and go their separate directions. Partners want to go their separate directions, and we'll discuss that. So, because of the whole reason why we're doing this webinar is the pandemic, and the IRS issued Notice 2020-23. I believe it was April 1st that this came out, but basically they gave an extension for investors that were affected by this COVID-19 virus. Now this is different from the regular presidential disaster declaration that generally would extend a timeline or a 45-day identification period 120 days. So under this IRS notice, here are two examples, and I'll just read it. It says, example one, exchange began April 1st, 2020. So that would make their 45th day May 16th. That date would be extended out to July 15th, 2020. Taxpayer must still close on replacement property by September 28th, which would have been their original 180th day. Because September 28th is the last day of the disaster period in July. So that's example one. Example number two is if the exchange started December 31st of last year, their 45th day would have been February 15th, 2020, prior to the notice. So the identification period is not extended because it started prior to April 1st. But the 180th day would be extended out to July 15th as opposed to the 180th day, the original 180th day. So that's the extensions that they've given those to investors that have been affected by the coronavirus. There's still some talks going on to see if they're going to retro this back to maybe the first of the year or extend it. It just kind of depends on what happens, with this whole pandemic, if they're going to start, getting things back to normal, but we'll kind of see what happens as we go. But that is currently what we have on the books. So moving on here, this is the actual 1031 section out of the Internal Revenue Code, and then I'll just read it. It says, no gain or loss shall be recognized on the exchange of property held for the productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for the productive use in trade or business or for investment. So in that little sentence, we have those three red phrases, or the held for, exchange, and like kind. Those are all highlighted, and those are our statutory requirements. That first one there is the only properties that qualify for this particular section of the tax code are properties held for the productive use in a trade or business or for investment. So personal use properties, primary residences, second homes, they do not qualify for this section of the tax code. They fall under different sections. The second one is the exchange requirement, and it must be a trade, if you would. Seller has to give up real estate and receive real estate. They cannot, accept or touch cash at any time. And that final one is the like kind requirement, which basically states, the property you're purchasing has to be like kind to the property that you're selling. We'll get a little bit more into that later. But again, in order to have a qualifying 1031 exchange, you have to meet those three statutory requirements. But basically, the basic gist of 1031 is if you own investment real estate and you want to sell it and go buy more, then you can take advantage of 1031 and defer your taxes. Occasionally, these are called tax-free exchanges. There's only one way to be tax-free, and again, that is if you die. Most people don't like that option, but under 1031, we can defer and defer and defer and defer and defer until we actually pass away. And then there's some interesting ways to use 1031 as an estate planning method. So, but with that, let's talk about the basis. Now, when we're doing 1031 transactions, we're transferring that basis from, we're transferring that basis from property to property to property. What the IRS wants to see is a continuation of the investment. And so when we sell, the gain is realized from that property, but it's not recognized, meaning that we have to pay taxes on it. So if we look at an example here, say I have a relinquished property that's worth $2 million. The basis, the replacement property, I want to just kind of move my property for $2 million. My basis is 1.5. That would have been my original purchase price plus improvements minus any depreciation I've taken. That is the basis of the property. So if I sell it, I have a capital gain of $500,000. That is the amount I would have to pay taxes on. Well, instead of paying taxes, I do a 1031 exchange. I get to defer that into my next property, and that basis of 1.5 is going to transfer over to that replacement property. And so, again, it's a continuation of the investment. I had a $500,000 gain when I sold. On my new property that I purchased, I have the same split. I still have a $500,000 gain. And so from there, I will continue to, hopefully it'll appreciate, and I will continue to depreciate that asset as well. And so we will continue on. So in a second example here, again, $2 million property, except this time I'm purchasing a higher valued property. And again, I still have that original basis of 1.5. And when I sell, I've got that $500,000. But my new basis in that replacement property, instead of being the 1.5, I'm just going to subtract the gain from the purchase price, which would give me a new basis of $2.5 million. And again, we would just continue on from there as we go. But again, it's a continuation of the investment. We may realize the gain, but we do not recognize it, meaning paying taxes on it. Now, going back to this code thing, let's talk about our statutory requirements. Again, they're the exchange, qualified use, and like kind. So the exchange requirement can be satisfied by what is known as a direct trade or a swap. Now, this would be as if, I own a piece of real estate and I have a friend or somebody else that I know owns a piece of property that I want, and they want my property, we could actually do a deed swap, and that would satisfy the exchange requirement. The exchange requirement, obviously, none of us touch cash. We both gave up real estate and we both received real estate. So that would meet the exchange requirement. Unfortunately, though, that is like a needle in a haystack. It's very difficult to go out and find a person that wants my property and they want mine. And so the majority of our transactions take place using what's known as a qualified intermediary. And the QI, if you would, basically allows an investor to treat this transaction like any other regular real estate transaction. They can sell to anybody, and then at close of escrow, the cash goes to the QI, so they don't touch it, so they don't have a taxable event. And now that investor can purchase from anybody. And so it really opens up the doors instead of having to be locked down with just that direct trade or swap method. Now, what makes that whole transaction work is this document known as the exchange agreement. Now, this agreement is put in place prior to close of escrow between the exchanger and the qualified intermediary on the sale of this relinquished property. The investor who's selling a property goes to the QI and says, hey, I want to do a 1031 exchange. They're going to get your information, and they will coordinate with escrow and send this documentation over to escrow prior to close of escrow. Now, what that exchange document does is it insulates the investor from touching the money. It allows the qualified intermediary to assign into the contracts on both sides of the transaction. And through that legal agreement, the investor transfers their property to the QI, who in turn sells it to the buyer in return for cash. Now, once that happens, the investor gets that, the QI has the cash, they transfer that property. Now the investor informs the QI of the property that they want to go purchase. They transfer the cash over to the seller. And again, regular close of escrow, and end up deeding the property back to the investor. But as you can see, the investor right here, they gave up real estate and they received real estate. They never touched any cash. And again, the instrument that makes all of that happen is the exchange agreement. Again, probably one of the most important things to remember is that that document has to be in place prior to close. If it is not, you do not have an exchange. Every once in a while, we get a client that will come to us and say, hey, I closed on my property yesterday. We want to do a 1031 exchange. Is that possible? And the answer is no, because at that point, at that point, they have not only, they may have actual receipt of the cash in their hand, but they also would have constructive receipt in the event that maybe the escrow hasn't transferred the equity out of their account yet, and it's still sitting in escrow. That's still a taxable event because they have what's known as constructive receipt of the funds. So again, got to make sure that that exchange agreement is in place prior to close of escrow. Okay, qualified use. This is our second statutory requirement. And again, to qualify for tax deferral under Section 1031, the property must be held for either the productive use in a trade or business. So, doctors that own a building that they're using their practice in, or anybody else that has a business that they're working in personally, or for investment. Those are the only types of properties that qualify. Now, that's very, very broad. So, that's pretty much everything if you really look at it. But what it is not, though, is it's not properties that are held primarily for sale. So, properties that are held primarily for sale would be considered inventory. So fix and flips of any sort, whether it be residential or commercial, do not qualify for 1031 purposes because they are property held primarily for sale. Now, what does the IRS look at to determine if a property is held primarily for sale? They will look at the intent and the actions of the investor to determine, if that property is held for investment or held primarily for sale. And if we're talking about a fix and flipper, obviously their intent is to buy the property, fix it up, and sell it. And again, it is property held primarily for sale. Some of the questions that the IRS will ask is, did they acquire to sell or have the property for, quote, what is a long-term hold? And what is a long-term hold? We get this question all the time. A lot of people have heard a year and a day. Now, a year and a day is something that a lot of CPAs and tax attorneys will tell their clients that they need to hold that property for, but that is not a requirement from the IRS. The IRS has not come out and said X number of days qualifies for a 1031. Most tax advisors will advise their clients to do this for reasons. One, if we hold it for a year and a day, it gets us into long-term capital gain as opposed to ordinary income tax rates. So obviously, long-term capital gain tax rates are considerably less than ordinary income. The other reason is because if we hold it for a year and a day, it puts the purchase of the property and the sale in two separate tax filing years. So potentially they could hide the transaction, if you would. If they buy and sell in the same year, that's going to show up on one tax return, and that could potentially raise a red flag for the IRS to audit it and look at it basically and go, oh, hey, you only held this for X number of months, it doesn't qualify. Not saying that it wouldn't. There's a lot of factors that surround that. Other factors that come into play, and I'll come back to that previous one there on long-term hold. How many improvements were put into the property? They're going to look at that. They're going to look at the profession of the investor. Are they a builder? Are they a developer? That will come into play as well. How many transactions they perform a year, that is also something that they're going to look at as well to determine if property is held primarily for sale. Now, not dealer property as we discussed, builder selling home or developer selling lot. These are all considered to be taxed as property held primarily for sale, which would be taxed at ordinary income. Now, going back to this property for a long-term hold question, if you've ever been, if you've been arrested, hopefully none of you have been arrested, but if you are arrested, you are innocent until proven guilty, correct? Well, if you get audited, is that the case? Well, the answer to that is no. You are not innocent until proven guilty. Actually, the burden lies on you to prove your innocence. And so if you get audited, you have to have a case that you can defend. And so there have been a couple of times when I've had clients who had acquired property, held it for, some had only held it for a month, and they got an unsolicited offer from another investor that wanted to purchase it. And because of their case, they were able to basically do another 1031 exchange and feel confident that if they got audited, that their CPA or their tax attorney could defend their position. And some of those, circumstances might have been the fact that they got an unsolicited offer, they never had listed the property for sale, they never hired a broker, and a number of different factors. But those are all factors that surround a case. And if your tax advisor feels that they can defend your position after only holding a property for maybe a month or even 6 months or whatever, you might have a case that is defensible and wouldn't negate you from doing a 1031 exchange. So let's continue on here about properties that do not qualify for 1031. Primary residences or second homes cannot do 1031 exchanges on them. If you do own investment real estate, say you had a condo out in California on the beach or something like that, or a cabin up in Flag, and you rent that property, under Section 280A of the code, the IRS allows 14 days a year or 10% of the rental period for personal use. So if you own a condo anywhere that you rent, you can use it personally 14 days a year or 10% of the rental period. So if you rented it for 300 days a year, you can use it for 30 personally. Conversions, we can always convert properties from personal use to investment. Some basically, we have to change how we file them on our taxes. This is really talking about more like second homes, or converting a second home into investment real estate. Just changing how you file them on your taxes, where you're going to be showing rents and depreciation, and have receipts and all that stuff. So, but those are the only other two properties that do not qualify for. So that takes care of our second statutory requirement, qualified use. The next one is like kind. And
Hey Dave, really quick, I'm going to interrupt you. Your sound is getting a little bit faint.
Okay.
So maybe, oh, now you're good. You're good.
Okay. It's the I got like a 6-foot rule on my computer, but I need to be like 18 inches from it or something like that. So
You sound good now.
Okay, great. Well, I'll stay nice and close to my computer here. So, all right. So like kind. This is the statutory requirement that's probably the most confusing out there. A lot of people will say, for instance, like with land, what's the investment strategy with land? Is there one? And the reality is it's buy it, hold it and hope, because you really can't depreciate land, and there's generally not a lot of cash flow generated off of land. And so basically our strategy is to buy it, hold and hope. Well, under 1031, in their mind, they're thinking they got like kind, which means that, well, if I sell my land, I have to go and purchase more land. That's not the case. We can actually sell that land and move them into a 1030. You can 1031 exchange into an improved property. And under the code, if we go back and look at it, what types of properties qualify for 1031? It's any property held for investment or use in a business, and pretty much anything, as long as it, again, is held for investment or used in a business. So our definition of like kind is very, very broad, but it's very, very powerful, because if we are in a property that maybe isn't, producing any cash flow, we can sell, a piece of land and move it into a commercial strip center or a triple net lease type of asset, where we're now getting rents and generally greater appreciation as well as some depreciation on the asset. So a lot of benefits there. But again, the definition of like kind is very, very broad. Again, it refers to the nature or character of the property, its greater quality. And so, that could be land, commercial buildings, ranches, rental homes, apartments, tenancy, common interest, easements, even leases of 30 years or more, including options, would all be considered to be like kind. Again, that list isn't a complete list. There's considerably more on there, but again, very, very broad, and a lot of different types of properties that you can move into as you move from property to property to property. All right. One of the changes that took place back in 2017 was under the Tax Cuts and Jobs Act. They actually eliminated this section of 1031. We used to be able to do 1031 exchanges on equipment, artwork, a lot of livestock. There was a lot of personal property that was used in the business or held for investment that we used to be able to do 1031 exchanges on, but they repealed this under the Tax Cuts and Jobs Act. So the only asset available to do 1031 on is real property. And so that is a change that recently happened back in 2017. So excluded property, never like kind under Section 1031, is property held primarily for sale, and we talked about that. It's considered to be inventory. Stocks, bonds, or notes, you can't sell real estate and move it into stocks, bonds, or notes, or vice versa. Securities or other evidence of indebtedness. Interest in a partnership. A partnership can do a 1031 exchange, but you cannot sell a partnership interest and 1031 out of it, or acquire one either through a 1031. Chosen action or a right to recover debt. And last but not least, foreign property for U.S. property or vice versa. We have to go U.S. to U.S., which includes the U.S. Virgin Islands, Guam, and the Northern Mariana Islands. So there's still a couple of nice islands we can still go to. So anyway, no Puerto Rico, though, for some reason. All right. Getting back to our exchange structures, we talked about the direct two-party direct trade. or swap. That's kind of a needle in a haystack. We also can do simultaneous transactions with a qualified intermediary, where the investor is selling to a buyer, cash goes to the QI, and again, the QI transfers to the seller and they deed that property back to the investor. We can do that simultaneously, but for the most part, most investors aren't that well planned out. And so, most of our transactions take place in the delayed format, and this is where we have the timelines. Now, the clock starts ticking at the close of escrow on the sale of this relinquished property. And that starts the clock ticking, and that first 45-day time period is known as the identification period. This is the time in which the investor has to identify what properties they're going to try and purchase from a seller within the remaining 135 days, and this is known as the completion period. Together, the total is 180 days. So an investor has 180 days to identify and acquire their replacement property. Now, these dates are set in stone. There's nothing moving them. So if day 45 falls on a Sunday, it's not rolling to Monday. If it's on a national holiday, or any other day, it doesn't matter. The 45th day is the 45th day. Now, we just talked about the extension that we got. Those are special circumstances, but in general, our 45th day is set in stone. So we have, again, 45 and 135, the total is 180. That is basically the time periods. We have to stick with those. Now, talking about the identification requirements. When we identify to the QI, it has to be in writing, has to be signed by the exchanger, and it has to unambiguously identify the replacement property, and has to be delivered to the qualified intermediary by midnight day 45. This is how we identify properties. Sometimes people will just send the QI a contract, an executed contract, or a PSA. It meets all of those requirements. Some QIs will have what's known as an identification statement that you fill out and send to them, but both of those would work in any scenario. So now, talking about the identification rules, we have 2 rules and 1 exception. There's the 3 property rule, and can anybody guess how many properties you can identify under the 3 property rule? You guessed it, it is 3, and it doesn't matter what the values are. You could identify any 3 properties to the qualified intermediary. Our second rule is what's known as the 200% rule, which is for investors that are looking to acquire more than 3 properties, and it allows them to identify twice the value of what they're selling. So if I was selling for $10 million and I wanted to diversify up and I wanted to go buy 10 $1 million properties, I could use the 200% rule. I would sell my one $10 million property and I could identify 2 times the value of what I'm selling. So if I was selling for $10 million, I could identify up to $20 million worth of real estate to the QI. Now, just because I identify them to the QI doesn't mean I have to purchase them. It just means that these are some of the properties that I'm going to try and defer my taxes on. That's basically what you're telling the QI when we do this. Now, those are the 2 rules that 99% of the time most investors will use. In the scenario, occasionally happens we have to go to this what's known as the 95% exception. If you violate both the 3 property rule and the 200% rule, you can still save the exchange by acquiring 95% of the value of all properties identified within a 180-day period. Now, to give you an example of what this rule means, if I went out and identified 5 properties, I obviously over the 3 property rule, and when I add up all the values, I accidentally went over 200%. And so in order to save this transaction, I have to purchase at least 95% of what I've identified. 5 properties. Let's say these 3 are worth 30 or 90% of the value of everything I've identified, and these last 2 are only 5%. Well, if one of those falls out of escrow, I'm still okay because I'm acquiring 95% if I buy everything by day 180. And that is, again, it's one of those exceptions that we rarely use, but it is out there. But again, most of the time we're using 3 property rule or 200% rule. Okay. Reverse and build to suit. Little bit of history on these. We got guidance from the IRS in 2000 when they issued Revenue Procedure 2037. And what this did was it basically gave the IRS a stamp of approval on these types of transactions. Now, what they created was a safe harbor for investors to use when they were doing these types of transactions. And the thing that they gave us in this revenue procedure was this exchange accommodation title holder. And what this allowed the investors to do was to park title while they were selling their other property. Now, under Section 1031, you cannot be on title to the replacement property and sell another property you own and basically exchange with yourself. And so they created this entity to go and park title while you sold your other property. And so how the transaction works is in a reverse exchange, obviously it's the forward exchange. So we're going to buy the replacement property first and sell the relinquished property later. So when would we use a reverse exchange? Well, sometimes we have a buyer for our relinquished property. Things are going great. We're under contract on the replacement, and all of a sudden the buyer for our relinquished property goes away. We still have an executed contract that we have to abide by on the replacement side. So we would use a reverse exchange in that scenario. Another scenario is when maybe the investor just finds that perfect property and they don't want to lose it, but yet again they don't have a buyer for their relinquished yet. And so again, we'll use the reverse exchange in this scenario. Now, when we are doing these types of transactions, again, the most common is parking the replacement property. And when we're doing these types of transactions, in phase 1, the investor is going to fund this entity known as the exchange accommodation title holder. And when I say fund, they either give them cash to go out and acquire the replacement property, or they would have to go out and get a third-party loan and then in turn give that money to that entity. And then again, this is an entity created by the qualified intermediary to hold title. And so once the EAT has the cash, they go out and purchase that property from the seller. And once that entity goes on title, well, that starts the clock ticking, right? Now the investor has 40, yeah.
Sorry, so I just got a question from Paul Woods, and so I copied it and put it into the group chat for everyone to see. So if you want to look at that before you move forward.
Okay, hold on a second here. I gotta find it. Hold on.
I can read it if you'd like.
Hold on a second. Participants. Where am I seeing this here? Chat. There we go. I've got it. Okay. If the property has been identified up to a QI during the 4-day period, but the deal falls through during the 180 period, can a new previously identified property be swapped in to replace the originally identified property? So, thanks for the question. If a property falls, a deal falls through, let's call it that, or it falls out of escrow. If you are in the 45-day identification period, you can revoke that identification and resubmit another one all the way up until midnight, day 45. You can submit identifications and you can revoke them. If it is after the 45th day, unfortunately, there is you can't swap it out after that. So in that regard, a lot of people use the 3 property rule, and maybe they want to purchase 2 of the 3 properties, but they'll have a backup property. But yeah, once we hit midnight day 45, you are locked into whatever you've identified, and those are the only properties that you can use the 1031 exchange funds on to purchase. Hopefully answer that question. Any other questions here? Let me check real quick. None at the moment. All right. So, so getting back to the relinquished property park transaction. So now the EAT is on title. Again, same identification rules apply. Once the EAT goes on title, the investor has 45 days to identify the relinquished property or properties that they're going to try and sell. And once once that property sells, the cash goes to the QI. It in turn repays the EAT, which either reimburses the investor for the cash that they brought in, or it pays off the loan or pays down the loan that they got to acquire the property. We see this transaction, used for parking replacement property. A lot of REITs will use this type of transaction when they're selling an asset, or they're looking to acquire an asset. Is they'll go acquire the property through an EAT, and then they'll put up a portfolio of properties, and whatever goes under contract first, that's what they use for the relinquished property. So it is a tool that is used and can be used for a lot of different scenarios. So that is parking the relinquished property. We can also park the the previous one was parking the replacement. We can also park the relinquished property, and again, it works the same, except again, the EAT's going to get money or cash from the exchanger or a third-party lender. Typically, the consideration consists of the EAT taking the property subject to the existing financing, and 2, a purchase money loan from the exchanger for the amount of equity. So the investor kind of has to guess what they think they're going to sell this property for and inject the equity side of it, because that's generally what we're dealing with in a regular 1031 exchange is the equity. Again, once the exchange accommodation title holder, this EAT receives the cash, they purchase they purchase that property, and again, it's kind of the same as the replacement, but the investor again has 45 days to identify what properties they're going to try and sell, and then again, they go ahead and close that transaction once it's completed. But again, we can park the replacement, where the investor would have to come up with the full amount of the purchase price, or we can park the relinquished, where the investor would have to come up with the equity amount or a third-party loan again. Now, one thing with reverse exchanges, the costs are considerably higher. Where a regular 1031 exchange, I think the industry average is right around $1,000. Could be a little bit higher, maybe even lower, but right around $1,000 for a regular 1031 exchange. Most of your reverse exchange types of transactions, or what we call parking transactions, are probably going to start around, I would say, $4,000 to $5,000. And the main reason for that is that they're creating this entity and they have to take title to it. So if they're on title, they're obviously, if it's an industrial property, they might require a phase 1 environmental. They don't want to assume any Superfund risks, so they might require that phase 1 environmental. They're going to have to carry certain insurances, if they're on specific types of properties. So there are some additional costs that come into play, when we're doing these types of transactions. But that's kind of a ballpark figure of around $5,000 where they will start at. So I think this is what we just already said here. So let's talk about delayed improvement exchanges, or build-to-suit transactions. So when do we use these? So the purchase price of the replacement property is less than the net sales price of the relinquished property. And what the investor, they want to put some improvements into that property with the excess exchange funds. And so looking at a transaction, if say we're selling a property for $1 million, and the replacement property is $600,000, and assuming we have zero debt on this property, that would leave $400,000 in the exchange account. If they were to sell, they would pay taxes, presumably, depending upon how much gain they have on this $400,000. So instead of paying taxes on that $400,000, they decide to do a build-to-suit exchange. And when we do a build-to-suit exchange, the investor, when they sell their property and going through the identification period, they're going to inform the QI that they want to do an exchange or a build-to-suit transaction. But when they make their identifications, they're not only going to identify the replacement property, but they're also going to identify in as much detail the improvements that they intend to make to the replacement property. And so on this particular property, we have $400,000 in the exchange account. They want to do a $300,000 remodel, and then additionally a $100,000 resurfacing of the parking lot. And so once we close escrow, cash goes to the QI to acquire that property, and then that starts the clock ticking. And again, the investor enters into a construction management agreement with the contractors. And I should say the exchange accommodation title holder enters into a construction management agreement with contractors to do the improvements that were identified by the investor. And so we'll start escrow closes, we start the remodel, the contractors get completed with the remodel, they come to the title holder and say, hey, we need to get the construction manager, we need to get paid. The investor checks it off basically and says, hey, this is good. So we pay them out of the exchange account, $300,000. We do the same thing for the resurface of the parking lot and pay them out of the exchange account. Our exchange account now is at zero. We have spent all of the equity that was in the exchange account. We have $400,000 of improvements. And now we have a fully tax deferred exchange because again, we sold for $1 million. We now have a property worth $1 million. And there was no debts. We'd have to replace it, and we spent all of our equity. So we have a fully tax deferred exchange. And again, this is all done through a build-to-suit type of transaction. Now, what's the catch on this? All the improvements have to be completed within 180 days. Now, this is really a race against the clock. Sometimes we have, investors that will buy a piece of dirt, and, it's just a race against the clock to get as many improvements into that dirt as possible. Within that time period, in this particular example, let's just say we didn't complete the resurfacing of the parking lot within 180 days, and we still had that $100,000 in the exchange account. Well, at the end of 180 days, the investor would just receive that $100,000, but they would pay taxes on just that $100,000. And so again, have to be pretty well planned out. When you're doing these types of transactions, most of the time it's basic TIs, but again, it just depends on how well you're planned out. But it is an option that is out there in the event you have a client that's going to be buying down and wants to put some improvements into the property. Okay. Moving on to refinancing. Refinancing before an exchange, it's not a good idea unless you can point to a separate business reason. Couple examples as a good reason that you would have to do a refi prior to doing the 1031 would be, you've got a loan coming due, you need a rate and term refi, or a small cash out refinance to get the property ready for sale. These are generally general reasons why an investor would do that. Now, it's generally considered better to refinance after the exchange, and so because of the simple fact that, here it is, a cash out refinance in anticipation of an exchange can be used as a method to avoid spending all the equity from the relinquished property. And so to kind of give an example of that, let's say, we were selling $1 million property, we have $200,000 of debt and $800 of equity. Now, if we were to do a regular 1031 exchange and have a fully tax deferred exchange, we would have to purchase a property worth of at least $1 million, replace that debt at $200,000, and spend all $800,000 of equity, right? Well, let's just say 2 months prior to me selling and doing a 1031 exchange, I do a cash out refi. Well, obviously I sold it for $1 million, but I did that refi and I took out $300,000. So now my debt is $500,000 and I have $500,000 in equity. And so I got, 300 grand in my pocket. Now, 2 months later, after I did the refi, I go ahead and I sell and I do a 1031 exchange. Well, I bought equal or greater, I replaced my debt and I spent all my equity. Well, but what's in my pocket still? It's that 300 grand. And the IRS would view this, again, as a step transaction in order to avoid paying taxes on that $300,000. The IRS views it as if you never did the refi, so you had the 800 in equity, you bought equal or greater, you increased your debt by 300 grand, but you never spent all of your 500,000, your 800,000, which would leave $300,000 in the exchange account, which would be taxable. So again, not a good idea to refi, right before the exchange. If you're going to do it, it's better to refinance after the exchange in a separate transaction. Now, sometimes we get asked the question, how long after the exchange or after close of escrow on the replacement property before we start the refi paperwork. And I've had CPAs and tax advisors tell me, some call it the nanosecond rule. As soon as we close the escrow, we can start the refi paperwork. Others, they want to give it a little bit of time before they start that refi paperwork. But talk to your tax advisor on what they're comfortable with there. Next topic up is related parties. Now, the general under 1031F provides an exchange between related parties will be taxable to both parties if either party disposes of the property within 2 years after the exchange. So if you are doing a 1031 and you buy from a related party, both of you have to hold on to your prospective properties for a time period of 2 years. This section was created to prevent basis shifting between related parties. And I got an example coming up. We'll look at that. So now, what is a related party? So this comes out of sections 267B and 707B, but it includes ancestors, so lineal descendants, siblings, spouse, and entities that the taxpayer owns more than 50% of directly or indirectly. If you own 25% of a partnership and your brother owns 50%, the partnership is related to you. Again, you own 25% directly and 50% indirectly. So again, this does not include in-laws, aunts, uncles, or friends, but you got to be careful in a community property state. Again, if you own a piece of property and your spouse has community property interest in it, your conveyance to or receipt from your in-laws will be a related party transaction. So you got to watch that. Now, in this example here, so husband owns Whiteacre. It's worth $1 million. It's got a basis of $100,000. And so if they sell it, the gain would be $900,000 if they sold it. Now, wife has Blackacre. It's also worth $1 million, but she has a basis of $950,000. So if she sells that, she will only recognize $50,000 if sold. So the husband wants to sell Whiteacre, but he doesn't want to pay taxes on the 900 grand. And so what he does is he tells his wife, hey, let's swap properties because your basis transfers, right? And so they swap properties, and gets Blackacre with a basis of 100 grand and wife gets Whiteacre with a basis of 950. They turn around and sell Whiteacre for $1 million and they only have to pay taxes on 50 grand. And result, again, they avoided paying taxes on $850,000. And this is, again, why the IRS came with rules regarding related parties and basis shifting. So you can do direct swaps, again, but you got to hold on to them for 2 years. You can't dispose of them. If one of the parties disposes of the property, both parties will be taxed and failed their transaction. If we're using related parties through a qualified intermediary, the buyer can be related to the exchanger. There's no issues with that. conservative taxpayers will want to have the related party hold that property for 2 years. If the seller is related, that is not allowed. Again, if they're receiving cash and cashing out, that is not allowed. In the event, if the the replacement property related party is also doing a 1031 exchange, we've had a couple of private letter rulings where that has been allowed as long as that related party is not cashing out. They've ruled favorably on that. So that is our related party rules there. Now, moving on to the same taxpayer requirement. When we're doing 1031 transactions, the general rule, title to the replacement property must be held in the same manner as title to the relinquished property. The person in title or entity in title, if ABC Corporation sells, then ABC Corporation must acquire. If ABC Corporation sells and a new separate corporation acquires XYZ, it is a transfer, not an exchange. And so where this really comes into play is, when we have partnerships. We'll talk about that in a little bit, but a couple exceptions to that, entity rule, if you would. The entity, the taxpayer has to be the same on both sides of the transaction. So single member LLCs, they are disregarded for federal tax purposes. So if the single member can either sell in the name of the LLC, and on the acquisition side of the replacement property, they could either acquire it in their personal name or in another single member LLC, as long as the same taxpayer is the single member. LLCs owned solely by husband and wife as community property. These again are disregarded. Grantor trust, revocable living trust, as long as the trust does not file a tax return, it is considered to be a disregarded entity. So again, bottom line is look for the taxpayer. We have to have the same taxpayer on both properties, on the relinquished property and on the replacement property. Okay, so finishing up here with partnership issues. A partnership can complete an exchange. There's nothing, any tax entity can do a 1031 transaction, but we can't do partnership interests as we discussed under the excluded property So, 3 techniques to resolve partnership issues. The first is what's known as a drop and swap. The second, it would be purchase interest in the interest of a retiring partner. And the third is the partnership sells the property, relinquished property, for cash and an installment note. Now, in a partnership, say we have 3 partners that own a property together, and they all decide that, they all want to go their separate directions. What they would do is the partnership would be liquidated prior to close of the relinquished property, and they would dissolve that partnership and then down into what is known as tenants in common, where each previous partner would own an undivided interest in that piece of real estate. After owning it for a certain amount of time, they would then, each new tenant in common would exchange their property and do a 1031 into their, whatever properties they wanted. Or if one of them wanted to just cash out, one of them would just receive the cash and pay taxes. Now, the biggest issue with drop and swaps is that most partnerships decide to do this at the closing table. And the problem with that is that when they dissolve that partnership at the closing table and create basically 3 new taxpayers through tenants in common, those new taxpayers would have only been on title for, a nanosecond, if that, and then they go ahead and sell the property and try to do 1031s. Well, those transactions get picked up because that new taxpayer was on title only for a short period, and if caught, or looked at, I should say, or audited, the IRS would fail that transaction because of the new taxpayer, again, held that property for sale because they were on such a short time period. So again, if we are going to do a drop and swap, the partnership needs to do this early. How early? Most tax advisors will tell them at least a year early. Get it on 2 separate tax returns. File the final partnership return, and then once converted to co-tenants, they each need to report those tax attributes of the property to their own tax returns. But again, it has to be done early. Issues with this, again, got to create that respected co-ownership. In this particular court holding company case, where an entity agrees to sell an asset and a subsequent liquidation and sale by the entity owners who receive the asset in the liquidation may be disregarded. They treated the sale by the partnership again, and they had to pay taxes. Gain is allocated to all partners. Now, even on our partnership tax return, there's lines 13 and 14 ask these 2 questions. It says, check this box if during the current or prior tax year, the partnership distributed any property received in a like-kind exchange or contributed such property to another entity. So basically, if you check that box, you're raising the red flag for the IRS to come and look at your 1031. And then that, obviously, question 14, at any time during the tax year, did the partnership distribute any tenants in common interest or other undivided interest in the partnership? So they are actually looking for drop and swap transactions. So again, get this outside of, at least a year on a hold period. All right, last one here, purchase interest of the retiring partner. Partners who wish to exchange, there have been some changes to the partnership rules. There was a change, or the previous rule was that at least there had to be 2 partners that controlled 50% or more of the partnership continuing on for it to be considered the same tax entity. That was changed, and they basically did away with the 50% requirement. And so if there are 2 partners that wish to continue and they have less than 50% partnership interest, those 2 can stay together and basically continue on. Before, it would have caused a technical termination. But now with this new rules, we can have 2 partners that maybe only control 30%, and they could continue on where one partner would cash out and the other 2 would continue on. So that is helpful. But another way for partners, if one of them wants to retire, they can infuse equity and buy out the partner prior to the transaction. Once this occurs, again, they can do a 1031. If they do it after the exchange, the partnership would continue as its original self, do the 1031, and then after the fact, do a cash out refi and then buy out the retiring partner. So this is another way to kind of deal with those particular partnership issues. And again, it just depends on the circumstances. The other option here is to do it, relinquished property sold for cash and an installment note. If the retiring partner is willing to take that installment note, the cash is used in exchange by the partnership, and the retiring partner obviously would get the installment note and then pay tax over the length of the note. So those are all just a couple of different ways for partnerships to dissolve and allow everybody to kind of do what they want. So with that kind of brings us to the end of our presentation. Do we have any questions? Let me go over here and open that up for chat. Are there any other questions? Hey, Lindsay, can you unmute people if they have questions?
Yeah.
Or go ahead and do that.
I mean, yeah, I'll just unmute everybody. So if anyone has any questions, feel free to chime in.
Yeah. So with that, if I don't have any questions, here's my contact information. If you would like, feel free to call me if you have some structuring questions or just kind of want to, talk about a transaction or maybe some, potential possibilities or some things, love to look at different types of transactions, and if we can assist you in structuring something, that'd be great. We work with a lot of tax advisors, and I will say this about tax advisors: they know all the entire tax code. I fortunately got to specialize in one section of it, so I've worked with a lot of great tax advisors and can help them if they need some assistance in making those decisions. But anyway, thank you for joining us today, and have a great week. And this, I believe, will be up if you want to come back and look at it again. Other than that, thank you for joining us. Appreciate it.
Thank you.
Thank you.